Hello, traders. Gary Wagner here. It is 12:03 in Honolulu and 6:03 in New York on Wednesday, 7th day of September 2022, and this is the daily report for gold and silver. The precious metals had gains overall on the day. Gold futures basis, the most active December contract, gained almost a full percent, 0.97%, or $16.60, moving an ounce of gold to $1,729.50. It was the direct result of both normal trading, with market participants bidding the precious metal higher, as well as U.S. dollar weakness. Although the dollar traded to its highest level in 20 years, coming in at 110.78, it did close lower, giving up about 0.6%, and is currently fixed at 109.53. Silver gained over 2.5% today, 2.64% to be exact, and after factoring in today's 47-cent gain, an ounce of September silver is currently fixed at $18.38. As you know, the dollar has been on a tear when compared to the basket of currencies it's paired with in the dollar index, moving from roughly 89 in June of last year up to a 20-year high above 110 after breaking above a minor level of resistance at approximately 109. What is interesting about today is that it traded to the highest level we have seen this year at 110.785. However, it had a key reversal, closing near the low today, with the dollar index currently fixed at 109.53. That obviously was highly supportive of gold and silver pricing today, accounting for over half of the upside move in both of those precious metals. We are looking at a daily chart of gold futures, and what is noteworthy in today's move is it's absolutely a respectable move, taking gold close to $1,730 per ounce, but we believe that it has a major hurdle, getting over $1,735, and when the Federal Reserve meets on the 20th and 21st of this month for the FOMC meeting, it is highly believed that they will continue their aggressive rate hikes and maintain another rate hike of 75 basis points or 0.75%. That could certainly limit any sustained rally in gold. Ever since gold dropped from the recent high at about $1,825 down to these lows that came in just below $1,700, we have seen a consolidation within gold and its price range, being limited to approximately, on the low side, $1,700, and on the high side, about $1,735. Our technical studies indicate that the first level of resistance comes in at the Fibonacci 61.8% retracement level, and that occurs at approximately $1,735, with support still being strong at $1,700. That level has held for the better part of this month and last. We did have one occurrence a couple of months ago in which gold did trade to 1680, but as you can see on this chart, quickly recovered, and that turned out to be the beginning of a pretty decent rally from 1680 up to 1825. When we take a longer-term view at the market through the eyes of a weekly chart, I still believe that there is solid support for gold between 1680 and 1700, as that is proven to be a resilient price of gold becoming oversold ever since it broke above that back in 2020. We have at least 4 instances labeled A, B, C, and D on this chart that clearly shows that market participants bought the dip, so to speak, every occurrence that we saw gold trade to that level. While it is clear that we do have a strong level of support between 1700 and 1680, the truth is we are in an absolute bear market. We can define that because of these series of lower highs that have come in after reaching the high of March, just $10 shy of the all-time record high, and a series of lower lows. Also, when we look at our three moving averages, they are in absolute bearish alignment, which is to say the highest value is the 200-day moving average, followed by the 100-day moving average below that, and the lowest value being the 50-day moving average at $1,755, which is why I believe that although there is good opportunities when gold reaches 1700 and holds 1680, that I think that there is limited upside momentum to witness gold have a sustained rally. One, the technical indicators are pointing to that fact, but more importantly, as long as the Fed is raising rates, we are going to see gold continue to trade under pressure because that will take yields higher on U.S. debt instruments. That will support the dollar. A higher dollar definitely takes gold lower. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.